If you've recently logged into the Check Your State Pension tool on gov.uk, you probably saw that number, £12,012 a year. Full new state pension. It's right there in black and white, and most people I know quietly breathe a sigh of relief when they see it. Job done. Sorted. That's the plan. But here's what that forecast doesn't tell you, and what the DWP hasn't exactly rushed to explain. For millions of people who worked in the NHS, in education, or for a large employer at any point before April 2016, the number you're looking at isn't the number you'll actually receive. There's a deduction built into the system, a hidden adjustment called COPE, that can quietly reduce what you get by more than £3,000 a year. Not a penalty, not a mistake, a feature. And the people most affected are often the ones who did everything right. They worked steadily, they paid their national insurance for decades, and they assumed that 35 qualifying years meant 35 years of credit. It usually does, but not always, and not for everyone. So why would someone with a full NI record end up with less than their neighbour who contributed fewer years? That's a question worth sitting with, because the answer tells you something important about how the whole system actually works versus how it appears to work. Over the next 15 minutes or so, we'll go through the real maths behind your state pension. What you've put in, what you're likely to get back, and how to spot whether the COPE deduction applies to you. If it does, there are things you can do about it. And the earlier you know, the more options you have. To understand why COPE exists at all, you have to go back to the basic architecture of the UK state pension, because it doesn't work the way most people assume it does. Your national insurance contributions don't sit in an account with your name on it. There's no pot, no fund, no ring-fenced sum accruing interest on your behalf. The money you paid in last month went straight out to pay the pension of someone who retired last month. That's the system. It's called pay-as-you-go, and it's been running that way since 1948. In 1950, there were roughly 10 people in work for every one person drawing a pension. The maths worked comfortably. But according to ONS data, by 2026 that ratio has fallen to fewer than 3 working adults for every retiree, and it's still declining. That's not a crisis invented by politicians, it's demography. It's the post-war baby boom working its way through the system, and it changes the pressure on every pound of NI collected. Take Graham. He's 62, spent most of his working life at an engineering firm in Birmingham. He's proud of having contributed, quietly, consistently, for 4 decades. He doesn't fully understand why his kids' generation talk about state pension as though it's already in trouble. As far as Graham's concerned, he did his part, and he did. That matters. But pride in the system and understanding the system are 2 different things, and the gap between them is where most people get caught out. The real question isn't whether Graham paid in honestly, it's whether the system, as it stands today, gives him back what that contribution is actually worth. So does the state pension actually pay out more than you put in? The honest answer for most people is yes, and by a meaningful margin. Research from the Pensions Policy Institute breaks it down fairly clearly. Women and lower earners tend to be net beneficiaries. They live longer on average, and because the state pension pays a flat rate regardless of what you earned, the maths tilts in their favour over time. A woman retiring at 67 in 2026 with a full state pension and average life expectancy will likely draw down well over £200,000 in total payments across her retirement. The one group where the numbers genuinely tighten is high-earning men, specifically the top 10% of earners, who paid in the most and often live slightly shorter lives than average. For them, the return is closer to break-even in purely actuarial terms. For most of us, though, it's a reasonable deal. A man retiring at 65 in 2026, living to 85, would collect roughly £240,000 in state pension over those 20 years, adjusted for inflation under the triple lock. The total NI paid in over a working lifetime, including employer contributions, typically sits somewhere between 60% and 80% of that figure. So, on balance, the state pension does what it's supposed to do. Wanting to receive every pound you're entitled to, isn't greed. It's straightforward. You worked for 40 years, you contributed consistently, and you'd like the return you were promised. That's not a complicated position. Which makes the next part all the more frustrating, because if most people are technically in profit, why do so many of them end up with less than they expected? That's where something called COPE enters the picture, and once you see it, you can't unsee it. This is the part most people miss, and I'll be honest, a few years ago, before I'd spent real time going through the detail, I assumed 35 qualifying NI years meant one thing: full state pension. Full stop. I was wrong. Here's what actually happened for millions of workers between roughly 1978 and April 2016. If you worked for the NHS, a local council, a school, or a large private employer with its own pension scheme, there's a reasonable chance you were contracted out of part of the state pension system. What that meant in practice was this. You and your employer both paid slightly lower national insurance contributions, and that difference was redirected into your workplace or occupational pension instead. The idea was that your employer's scheme would cover that portion of your retirement income, so the government didn't need to. At the time, most people didn't notice. The NI deduction was modest, the workplace pension felt like a bonus, and nobody handed you a leaflet explaining the long-term implications. It was just how it worked. But here's where it becomes important now. When the new state pension launched in April 2016, the government had to work out a starting point for everyone. If you'd been contracted out, they calculated something called your COPE, your contracted out pension equivalent. This is the portion of state pension that your private scheme was supposed to replace, and that figure gets subtracted from your state pension entitlement. The problem is that your state pension forecast doesn't make this obvious. You see the full figure, £12,012 a year, and below it, in smaller print, something like your COPE estimate is X per week. Most people read that as additional information. It isn't. It's a reduction. The DWP is telling you that part of what looks like your state pension is actually expected to come from your workplace pension instead. If your COPE figure is £60 a week, that's roughly £3,120 a year that won't come from the government. It's meant to come from your occupational scheme. Whether your scheme actually delivers that amount is a separate question entirely, and one worth checking. Margaret spent 40 years paying NI. So did her husband. When they both retired, his state pension came in at the full rate. Hers didn't. She'd spent 20 of those years working in an NHS trust, contracted out the entire time. She hadn't done anything wrong. She simply hadn't known, and nobody had thought to explain it clearly before she stopped working. That's not an unusual story. It's a common one. So what do you actually do with this information? If you were contracted out, check your state pension forecast carefully. Not just the headline figure, but the COPE line underneath it. Then check whether your workplace or occupational pension is genuinely on track to cover that gap. If it isn't, that's the number you need to work with. The situation is fixable for many people, but only if you know it exists. Knowing about COPE is one thing. Doing something about it is another. So here are 3 concrete steps, none of them complicated, all of them worth doing before you get within 5 years of retirement. Step 1. Check your NI record properly, not just the number of years, the quality of them. Log into your HMRC personal tax account at gov.uk and look at each year individually. What you're looking for is whether each year is marked as full. A year where you earned below the lower earnings limit or where you had a gap between jobs might show up in your total count but not qualify as a complete year for state pension purposes. The headline number of qualifying years can be misleading. The detail is what matters. I helped a friend do exactly this a couple of weeks ago. We pulled up their HMRC record together, went through it year by year, and found 2 years marked as incomplete, both from around 2004, when they'd moved between employers and fallen through a gap in the system. Not their fault. A small administrative error that had sat there quietly for 2 decades. One phone call to HMRC sorted it. Step 2. Consider buying back missing years through voluntary Class 3 national insurance contributions. The current cost is around £907 to purchase one additional qualifying year. In return, you gain roughly £340 more per year in state pension for the rest of your life. That means you break even in under 3 years of retirement, and everything after that is a return on your investment. There is a deadline to be aware of. The window to buy back years going as far back as 2006 was extended, but that extension has now closed. You can currently fill gaps going back 6 years. If you have older gaps you're concerned about, it's worth contacting HMRC directly to understand your specific position, because the rules around this do vary depending on your circumstances. Step 3. Think carefully before assuming you have to take your state pension the moment you turn 67. If you have other income, a workplace pension, savings, a partner still working, and you don't need the state pension immediately, deferring it increases the amount you'll eventually receive by 5.8% for every full year you wait. It's not right for everyone, and the maths depends on your health and your other income sources. But it's an option most people don't seriously consider, and for some it makes a real difference. None of this requires a financial advisor to get started. The HMRC personal tax account, the Check Your State Pension tool, and a pen and paper to work through the numbers, that's most of what you need for the first pass. But before you do any of that, there's a psychological barrier I see come up almost every time someone looks at this properly for the first time. And it's worth naming it. When people first see the COPE deduction on their forecast, the reaction is usually the same. Not confusion, anger, a feeling of having been quietly misled, decades of contributions, a number they'd planned around, and then a line in small print that changes everything. That reaction makes complete sense. It isn't an overreaction. But I've watched what happens next, and this is where people tend to split into 2 groups. One group stays in the anger. They spend their energy on the injustice of the system. How the government should have explained it better, how they were never told, how something ought to be done about it. All of which may be true, none of which changes their pension. The other group does something different. They sit with the frustration for a bit, then they move on to the question that actually matters. Given where I am now, what can I still do? That shift, from what was done to me to what can I do with what's left, is the whole game. Not because the anger isn't valid, it is. But because the sunk cost is gone either way, and the only variable still in play is what you do next. The framing that tends to help most is this: stop thinking of state pension as a government benefit, something handed to you by an institution you have limited control over. Start thinking of it as a personal asset, one with rules, with gaps you can fill, with timing decisions that affect its value. You wouldn't leave a savings account with errors in it unchecked for years. This is no different. The system was designed to be complicated. That's not a conspiracy. It's the natural result of 7 decades of policy layered on top of policy. Not understanding COPE before today doesn't mean you weren't paying attention. It means nobody handed you the right information at the right time. You're not behind, you just have some catching up to do, and most of it is genuinely catchable. If you find this kind of detailed, practical breakdown useful, the sort that actually tells you what the numbers mean and what to do with them, then subscribing means you'll see more of it. That's what this channel is for. There's one scenario that catches people particularly off guard, and it's worth spelling out clearly before we finish. Say you're planning to retire at 60. You stop working, stop paying national insurance, and you intend to live off savings or a workplace pension for 7 years until state pension age. You've checked your record, you have 35 qualifying years, and you assume that's sufficient. In many cases it is. But if you have a significant COPE figure, if you were contracted out for a substantial portion of your career, the calculation shifts. Your full 35 years may not actually deliver the full new state pension in real terms, because the COPE deduction is applied on top of your qualifying year count. You can clear the year's threshold and still fall short of £12,012 a year once the contracted out adjustment is factored in. Stopping NI contributions at 60 means you lose 7 years of potential additional contributions. For someone without a COPE issue, that probably doesn't matter. They're already at the full rate. But for someone with a meaningful COPE deduction, those extra years between 60 and 67 might have been the years that genuinely closed the gap. The Money and Pension Service has flagged this specifically. People who retire early and don't account for the interaction between COPE and their qualifying years are among the most likely to face an unexpected shortfall when state pension actually begins. Not a small one either. We're back in £3,000 a year territory for those with higher COPE figures. The fix is straightforward, at least in principle. If you're planning to stop work before 67, run the numbers on your specific record before you do, not the headline forecast, the full breakdown including your COPE estimate. And if there's a gap, voluntary contributions are still available while you're under state pension age. Early retirement is absolutely achievable. It just requires knowing what you're working with first. State pension, on balance, is a reasonable return on what most of us put in. The maths, for the majority of people, comes out in their favour. That part is genuinely good news. But the system is complicated in ways that matter, and the gap between what your forecast shows and what you'll actually receive can be significant if COPE applies to you. That's not a minor technicality. For some people, it's £3,000 a year, every year, for the rest of their retirement. So the 3 things worth doing, if you haven't already, pull up your state pension forecast and look for the COPE line, not just the headline figure. Check your NI record on your HMRC personal tax account year by year for gaps or incomplete years. And if you're within a decade of retirement, run the numbers on whether voluntary contributions make sense for your situation. I don't have a way of knowing what pension policy looks like in 2030 or 2035. Nobody does. But the data we have right now, for the tax year 2026 to 2027, is clear enough to work with. And the people who understand how the system actually operates, not just how it appears to operate, are the ones who tend to make better decisions with what they have. That's all this is, really. Not a guarantee, not a prediction, just a clearer picture of what you're dealing with. If you found this useful, share it with someone who's thinking about retiring in the next few years, particularly anyone who spent time working in the public sector or a large organization before 2016. They may not know the COPE question even exists. Now you do.